Hey everyone, good morning, good afternoon, good evening. Thank you for joining us this morning here in San Francisco. My name is Peter Walker. I'm the head of insights at Carta. And today we're doing a deep dive into the concept of dilution, in particular, dilution for startup founders. Now, this topic we could spend a day and a half on this topic, not merely an hour, but we're going to try to get through as much as we can in an hour and hopefully leave time for questions at the end as well. So a couple notes on logistics here. If you're watching and tuning in on LinkedIn, you can leave comments under the event, and then I can pop them up on screen and we can have a little bit of an asynchronous Q&A. That would be great. So if you have comments as we go through this, please throw them into the comment section on LinkedIn, and we'll go ahead and get those up on the screen for you. So how to think about dilution. So if you're unfamiliar with dilution as a concept and you're a startup founder, it's one of the most important things that you can wrap your head around because it implies how much of your company you're going to own at the end of the day. We'll kick off things with a word here from our wonderful Carta lawyers. I hope you can all read that. And then to anticipate a question that I'm sure we're going to get later on, yes, you can get this deck. And yes, this is being recorded and you can watch it back later. And a third and final, yes, you can indeed ask questions, as I mentioned, using the comments on the LinkedIn event. If you'd like this deck afterwards, if you find it helpful, just email me or shoot me a DM on LinkedIn. My email is peter.walker@carta.com. Dilution, the reason we're all here. So this is also known as equity dilution, share dilution, stock dilution, whatever concept you want to call it. It's the decrease in your ownership percentage for existing shareholders when a company issues or reserves new shares of stock. So it is a reduction in the ownership percentage, but not the ownership number of shares for any existing shareholders when you take an event that changes the number of shares that have been issued in your company. And it really boils down to this: how much of your company are you planning on owning when you go ahead and ring that bell at the NASDAQ, when you IPO or when you get acquired? What will the founder ownership share be at the moment of acquisition or IPO? In some cases, it might be as high as 75%. Atlassian in, 2015, had 75%. The founding team owned that much of the company when they IPO'd. Or you could be DocuSign. And in 2018, DocuSign IPO'd and the founders owned less than 2% collectively. Is this good? Is it bad? There's no moral judgment here. The DocuSign founders walked away with tens of millions of dollars each. I'm sure they were pretty excited about that outcome. There's no right answer to the concept of dilution, but it is really important to track over time because it has impacts on whether or not investors are going to view you as an investable asset. And that is really key if you're planning on fundraising through multiple rounds of venture capital. So we're going to walk through the main sources of dilution today, and we're going to spend particular amounts of time on fundraising. But we got to start at the very beginning. What is the main source of dilution? It's actually your co-founders. As you can imagine, the number of co-founders that you have in a company really radically changes the amount of ownership that each one of those co-founders has as they move through the journey. So here's a little bit of data. It's a study of over 7,500 startups on Carta. First things first, the most common team size for founders on Carta is 2 founders, you and a co-founder. There are a ton of solo founders, and there are also a lot of 3, 4, 5 founder companies. They're not shown on this graph, but there are 6, 7, even 8 or 9 founder companies. I don't recommend having 9 founders. That sounds like a really terrible decision-making tree, but it does happen. In this graphic, the companies that are more traditionally SaaS, software, etc., they move towards the lower end of the founder count. And companies that are working in biotech, hardware, technical sciences, they tend to have slightly more founders near the very beginning. This data comes from when a company is just starting out. before they've fundraised and before they've hired any employees. So this is kind of a snapshot at that very earliest stage. You can add co-founders later on. That's also a pretty common thing to do. So of course, when it comes to dilution, this is the major question. If I have 100% of a pie, and that's all the pie I'm ever going to have, how do I split it amongst these co-founders? Well, it turns out that most companies split this unequally. I'll say that again. It's kind of a counterintuitive when you read all of the, startup news of the day. Most founders do not split equity equally, even at the very beginning. So for 2 founder teams, 56% of them split unequally. So you can imagine, a lot of companies go 50-50, but a lot of companies choose a different point along those spectrums. And 3, 4, 5 founder teams, unequal splits become by far the norm. I mean, when you get to 4 founder teams, nearly 90% of them are splitting unequally. And you can imagine there's a little bit of a logical reason here. If you just go 25% for each of the 4 founders, how are decisions made? How are gridlocks unlocked? What happens when both sets of founders, 2 on one side and 2 on the other, disagree about an important decision? It kind of clarifies the decision-making process within your company to have an unequal split. But again, I don't want to pass any moral judgments here. If you are 2 founders and you split 50-50 after some serious discussions, amazing. That's a wonderful way to build a business. So what are the median equity splits in this initial dilution event, which is, of course, bringing on a co-founder? The first one is 55-45. So if you have 2 founders, the first founder typically takes 55% and the second founder takes 45%. If you go ahead and look at 3, 4, 5 founder companies, there's a clear pattern that emerges. First off, there is a first or lead or primary founder that takes a little bit more equity, an outsized portion of equity, versus the rest of the founders on the cap table. It's pretty obvious that this person is typically the CEO, not always, but almost always the CEO. And then the rest of the founders kind of fall off in terms of their ownership percentages. There's a very clear sort of lead founder pattern. So that is, again, a major impact to dilution. If you are joining a company and you are not going to be a CEO, but you are going to be a co-founder, you should probably expect that your initial equity package is going to be less than that 50% mark, maybe even significantly less than that 50% mark, especially if you're joining a company that has 4 or 5 co-founders. This is a really big deal when it comes to managing dilution. And I'll just kind of reiterate the point. The largest single decision impacting your ownership in your company is the number of co-founders that you have. It is going to be more impactful than the number of investors that you end up bringing on board, much more impactful than the number of employees down the road. It is the single decision that is going to change that percentage the most out of anything that you do when you raise and fund this company for the next 10 years. So this is the most important thing. I love, love, love the idea of starting with co-founders. I think it's a wonderful journey to take together, but it is a marriage. That is the one metaphor that I think makes the most sense. You should take this decision about bringing on a co-founder very seriously. All right. We'll whip through the other sources of dilution at the very earliest stages. Advisors, you'll probably give these advisors a little bit of equity. Candidly, it's not a ton. The advisors that you are giving equity to, they're probably only going to be receiving between 1/4 and 0.5%. Now, if you do that multiple times, it can add up. But typically, we see pre-seed advisors starting at about 0.25% of the company. And then if you are, in the seed or Series A stage, you're bringing on advisors, because you've de-risked the asset, they're probably going to get a little bit less. Then you get to early employees. This is an interesting part because it is a widely variable source, quote unquote, of dilution. Personally, I don't love seeing this as a source of dilution. This is incentivizing the people that you're going to need to build with to build as owners, to create the company that they want to be a part of so that they can share in a wonderful exit down the road. And you can see that founders are sort of increasingly taking that stance, at least over the last couple years. In this chart, the green bar shows the median percentage for each one of these hires that was granted when they were hired in 2022. And the black bar shows the exact same hire, but hired in 2023. And you can see that basically across the board, founders are being a little more generous with early employees. I think that's awesome. Why is that happening? Especially in light of all the downturn that's happening in startups. If I'm honest, I think that's probably due to the fact that many founders are thinking we're actually not going to need as many employees as we initially thought. So maybe we incentivize those early joiners a little bit more because we don't think we're going to have a massive headcount increase as we get to Series A, Series B, and beyond. I think that's a fantastic way to build a business. I think early employees are sort of the bedrock of startups. And if you think about the risk-adjusted equation that's going on with early employees, they're not taking more risk than a founder, but they are taking significant risk for much less equity. So perhaps that risk-reward ratio is actually worst for early employees when you look across the entire startup sort of early believer ecosystem. Certainly it's worse than it is for investors who are contributing cash, but not contributing their day-to-day livelihoods to this business. So in some ways, I think that these numbers could be even higher. And we love, when founders are generous with early employees in their startup. Then you get to the rest of the employees. So you've hired a couple, maybe 3, 5 employees, and you really need to organize your rest of your equity that you're going to give out to employees into what's called an employee stock option pool. This pool probably starts around 10% or so, and then gets all the way up to about 20% or even 25% when you're a very, very mature company. I would start it at 10 and then rise through the ranks, because we're going to see in the live model how that can impact the amount of ownership that you as the founder have. So there's no need to dilute yourself early on. You can set aside much more equity for employees down the road. Hey, Samuel's got a great question here before we go on to the next one. I'll read it out loud, or actually I'll just show it on screen. If a founder decides to exit a startup early and exercise already vested equity, how will this affect dilution? This is a wonderful question. So if you and your co-founder have a breakup, the marriage just didn't work out, you're getting divorced for X, Y, or Z reason, that founder will walk away if they vested their equity with the percentage of the equity that they've vested, and it is no longer useful to your company. That is a big impact to your future fundraising prospects for a couple reasons. First off, most of the time, founders are not exercising their shares because their shares happen as RSAs, not ISOs. That is an issue, because if they have RSAs, that means they are awarded that stock. If it's vested, they can walk away with it, and you really don't have that many mechanisms to get it back from them, except for, perhaps some cash incentives or actually paying for it, which can be really challenging if you are a small business and you don't have a lot of cash. So the number one thing, Samuel, to take away from your question is that every single founder and every other person in the business as well should have a vesting schedule applied to their shares. It is the number one piece of advice I can give you. It will save you from a divorce between two co-founders, and it will add to your future equity pie, because if there's a vesting schedule, they won't walk away with the full, say, 50% that they could have. They'll walk away with 10 or 15, however long they've stayed at the company. So it is a much, much bigger deal to have a vesting schedule than to quibble over the last tiny little bits of percentages. I hope that's helpful, but it's a major impact to dilution down the road. Okay, let's get into the main event, which is fundraising. I'm going to take a sip of coffee here just to get ready. So, fundraising across all types of fundraising for mostly venture-backed startups. The data that we're showing here is for startups that are trying to take in venture capital money, and they're all US startups, just to kind of narrow the field a little bit. I want to start by explaining what you all probably think is super basic, but just in case we wanted to start from bedrock principles. When you fundraise, you are not taking shares away from anyone who owns shares in your business. You are not reaching into their Carta accounts and moving shares around. That's not what's happening. You are simply adding more shares to your overall capitalization of the business. And those new shares go to investors, which obviously makes your current slice of pie a little smaller. So again, the most basic possible example, this is what happens when you add investors to a cap table. In the first pie, you've got it sliced right down the middle. Founder 1 has 50% ownership and 1 million shares. And founder 2 has another 50% ownership with the other 1 million shares. So there are currently 2 million shares outstanding. When you fundraise, you are not taking any of those 1 million shares from founder 1 or founder 2. You are simply adding more shares and giving those new shares to that pink investor. And that investor would walk away with, in this case, 10% ownership. And the dilution for founder 1 and founder 2 would be 5% each. So they still own those 1 million shares. There's just more shares outstanding. So those 1 million represent a smaller percentage of the total pie. This can be, it can be incredibly basic. Perhaps you're all giggling at me behind the screen, but it can also be a little bit tough to track because it's a bit of a different concept than saying we have these slices of pie and we merely just take them from one person and hand them to another. You're just consistently adding, you're raising the size of that pie into total shares, and that's where dilution comes in. So how is your fundraising dilution going to start? You're probably, if you're raising in the US, going to start fundraising on safes. Let's focus on the left side of this chart. That orange box denotes what we would consider friends and family or angel rounds. Something between, if you're raising less than $200,000, it's probably a friends and family. If you're raising between, say, $200,000 and $400,000 or $500,000, even though that can sound like a lot of money, in the venture capital ecosystem, that's still a relatively small fundraise. So maybe that's called an angel round. And in each of those places, you are selling equity. It may not feel that way because you're doing it on a safe, so you don't actually sell the equity up front, but you are selling equity. That's what's happening when you fundraise on safes. And the percentage of equity can be widely variable. You know, for a small friends and family, perhaps you're selling 1 to 3%. Maybe in the angel round, you give up another 2 to 4% or even 5%. And then you can see as you go to pre-seed in the black in the middle, or seed rounds, which are in the blue on the right, you sell more equity, the more fundraising that actually happens, which makes intuitive sense. If you're raising $1 million, you're probably going to sell more of your company than you're raising $250,000. This can, the way that we just explained it super quickly, can seem pretty simple, but it gets very tricky because the safes do not convert at the moment that you sign those documents. You get the money up front, and the safe converts into equity down the road when you actually end up raising priced financing. That is a challenge to keep in your head. We'll dig into how you can model this on Carta and some of the reasons why we think it's important to keep track of it. But just know that safes are not free. They feel free, but they aren't. And if you stack multiple safes, that cap table mechanics, that cap table math can get pretty complex pretty quickly. So you're going to start on safes. Maybe you do an angel and a pre-seed. The other thing to note here is founders, you do not need to hit every one of these stages. In fact, I would highly recommend that you skip some rounds. Maybe you only need 250,000 to get started, and then you jump all the way to a Series A round. Whatever you want to do. There's no reason to go through every single fundraise. That's just the venture capital pathway that's laid out. Think of it like hopscotch. You can jump some steps whenever you want. So when you get to priced equity, when you get to those standard venture capital rounds that we read about in TechCrunch or Crunchbase or Business Insider occasionally, how much of your company are you going to sell in each one of these rounds? It turns out that the standard advice, which is 20% in a seed and 20% again in an A, is actually pretty true. It holds just about right when you look at Carta data for the entirety of 2023. 20.7% sold in a seed and 20% in a Series A. Series B, you know, a lot more variation here. I would call it between 12 and 16 or 17%. And then Series C and Series D, as your company gets bigger and bigger, you're going to sell smaller slices to individual investors that are coming into the cap because it's a much more substantial business than those early believers who were really just betting on you as a founder. So Series C and Series D, it's something like 10%, but again, lots of variation here. It could be as little as 2%, as much as 15%. And this is actually a really hopeful chart for founders. There are a lot of indications that for primary rounds, the amount of dilution that a founder is taking on is actually decreasing year over year, meaning you're selling less of your company in the median round than you would, say, if you had fundraised in 2020 or 2018. Why is that happening? There's a whole host of reasons, probably having to do with the professionalization of venture across startups, venture taking root in ecosystems that are not Silicon Valley and New York, where prices are pretty high, and now perhaps they're coming more towards the mature market prices. There's a lot of reasons for this, but in general, again, if we just highlight the trend, that's a pretty great trend for founders. You used to sell 22% in the Series A, and now you're selling 20%. That's more equity that you own when, again, you ring that bell on the NASDAQ. So this is the hopeful side. The not so hopeful side. There are a lot of ways to dilute yourself that are not just primary rounds. In fact, there are more bridge rounds happening than have ever happened before across our data in Carta, going back to about 2016. So what is a bridge round? Let's explain the terms here. A bridge round is any time you are fundraising in the same series before getting to the next series. Most bridge rounds happen with people that are already on the cap table. So this is you going back to your current investors and saying, we thought we were going to be able to get to a Series A with $3 million. Unfortunately, it looks like we're going to need another $1 million in order to get to the metrics that we need to get to Series A. Can you give us that extra $1 million? And in some cases, actually in many cases, as you can see from these orange bars, those investors are willing to re-up in your company, but they're not going to do it for free. They're going to ask for more equity when you raise that extra $1 million or 2 million or 500,000, whatever the number is. So you can see that bridge rounds are much more common than they used to be. It seems as though a lot of current portfolio companies for these venture funds are all going back to them basically at the same time and asking for more money because the world shifted underneath their feet and they thought the metrics that they were going to need to hit a Series A were X and they turned out to be Y. What are X and Y? Depending on who you talk to, it's different. It used to be the common idea was you need $1 million in ARR to raise a Series A as a software company. Now it might be 2. I'm hearing 2.5. I'm hearing occasionally 3 million in order to raise a Series A. So it has definitely gotten harder. Venture capitalists are being more diligent, more scrutinizing on these terms than they have been in a long, long time. So I think kind of unique to Carta, we can actually see how much you're selling in either a primary or a bridge round. And the differences is pretty vast. So in a primary Series A round, the median founder will sell about 20% of their company. In a bridge Series A round, they'll sell about 9.9 or 10%. So about half. And you can see that pattern basically repeats itself no matter what the stage is. It's a little bit different at seed, but generally speaking, bridge rounds are coming in at about half of what primary rounds are. So if you add those up, if you do a primary seed round and sell 20% of the business, then you need a seed extension, seed plus, seed senior, whatever you want to call it. You need a bridge before you get to the A. You might sell another 10% of your business. So actually in the seed stage, you ended up selling 30% of your company to investors. That's a lot. That's a real lot of the company. If you and the co-founder started out with 50% each, 30%, a 15% haircut to both of your stakes, that is nothing to joke at. And you really, really feel the impact of that when you end up having to raise a bridge at the A or the B round as well. So again, the biggest advice to founders is if you can avoid raising bridge capital, do so. It is much better to not have to bridge, which may involve raising a slightly bigger round at the primary to give yourself some more buffer. I know that's maybe optimistic thinking because it's very hard to raise a round in general right now, but The bridge round equity dilution is one of the biggest stories that we've seen over the last couple of years, and it is a much bigger part of total equity dilution than it used to be. And that's not the end of bridges. So all the data that we just looked at, that's for priced bridge rounds, which are definitely still a major impact for bridges. But there's also these wonderful safes and convertible notes, which can function as bridge rounds, but are a lot messier. So say you raise a seed round, it's a priced equity round, you have a valuation, it's a normal standard venture capital deal. You may then go back to those same investors and raise on a safe in between your seed and your Series A. That's that first column right there between seed and A. You can see that 757 companies on Carta raised at least a little bit more capital on a safe than they did in between a seed and an A in 2023. That is a gigantic jump from where it was in 2020 and 2021. And you can see this is happening in between A and B. It's happening between B and C. It's happening between C and D. It is I wouldn't call it an epidemic, but I would call it perhaps a contagious trend right now that a lot of companies are raising bridge round capital on convertible notes or safes. That can be an issue. One, because you don't actually know what's going to convert there. So you're not 100% sure how much dilution you've taken on in those bridge rounds. And two, because it makes the valuation a little bit muddled as well. You have a valuation cap on a safe, but it's not a valuation. And it seems a little bit odd to me that so many of these convertible instruments are being used when there's already a valuation on the business. You know, the original intent of the safe was to make up for that pre-seed stage where valuing a company is really hard. But why do you need a pre-seed instrument between Series B and Series C rounds? Well, 85 companies on Carta did that last year. So it is an odd feature of the venture ecosystem that these convertible instruments are being used in ways that perhaps they weren't really intended to be used originally. Good question here from LinkedIn user anonymous. Apologies, I don't have your name, but what is the median amount of equity for AI startups to give up in a seed round? Yeah, so AI startups, it's the hottest sector right now. It is the one that's getting all the attention. Generally speaking, though, they're still selling about 20% in a seed round, maybe a little bit less, like 19%. And the reason being is because the rounds that they're raising are actually larger. So the valuation is larger, the round size is larger, but those two things are kind of equaling out to come up with just about, again, 19 to 20%. So those are, that's still the median dilution for seed rounds, even in the AI sector, but it's a good question. You know, getting comments here on the convertible slide. Yes, part of the reason why these convertibles, I'll show Sherwin's comment here, give the VC control for the incremental risk. I think this is a wonderful point. The reason why a VC might prefer to do this on a convertible, there are multiple reasons, but yes, they get incremental control after they've already had the backstop of the priced round. However, they also, and this is kind of a cynical take that I'm taking from Dave McClure here of 500 Startups and Impractical Ventures, they also get to not mark down this company. So if you have a valuation cap on a convertible, it's not a valuation. So you don't actually have to change the valuation if that company was indeed going to do a down round in the later stages. So it can be more beneficial to the fund economics of the VCs as well. You know, why are safes a thing now? What are the pros and cons of a price seed and a safe from founder and investor perspectives? I love this question. I'm going to get to it when we do the modeling in just a bit. Don't worry. This is going to be like a big topic of conversation. Yes. Is it a seed round percentage for a social networking startup? Aziz, the same sort of applies. It's actually a little bit more probably for consumer businesses, something like 21 or 22%, but same kind of general ballpark. And Ryan, I don't want to answer your question on stage because I don't know if all this information applies to the UK super equally. I'm not candidly as much of an expert there as I pretend to be one here in the States. So apologies. So again, we'll kind of move on from the idea of convertible notes, but just know that there's all these ways to dilute yourself as a company. Convertibles and safes just happen to be this new and interesting one that's happening a lot more across venture than it used to. So let's go ahead and do some modeling. Let's look at what this actually looks like when you go ahead and do some of these safe conversions in a model. So I'm going to jump in right now to the Carta Launch platform. Give me a moment. All right. So on the screen, we're showing Model Your Fundraise, which is a tab available in the Carta Launch platform. If you're unfamiliar with Carta Launch, it is entirely free cap table with basically all of our wonderful features until you raise $1 million. So again, this is 100% free. You can find it on carta.com/launch. And one of the amazing things that it has in it is this Model Your Fundraise tool, which allows you to understand the impact of fundraising towards your ownership and then hopefully eventual exit. So let's start with saves. Okay, so imagine you are a pair of founders. You've decided to launch this company, you've built it for a little bit of time, and now you're ready to start adding investment. Your first investors are going to be some friends and family. You happen to have some pretty awesome friends and your family's pretty cool too. So they will go ahead and invest $200,000 in your business on a safe. That's a post money safe. Side note, pre and post money definitely affects dilution. About 85% of the safes on Carta are post money. The reason being is that it just allows you to to have a little bit more certainty into how much of the company you're going to own. That's good for the investor. It's a little bit less founder friendly, but it's not bad. So we're going to do a post money safe. We're not going to use a fixed conversion percentage. This is pretty uncommon, but if you're raising from Techstars or YC, then you're actually just going to sell an exact percentage of your company to them for an amount of money. And the valuation cap is not even going to be discussed really. But in this case, we're selling $200,000 or we're raising $200,000. And the company's pretty young. So let's say that you had a valuation cap here of $4 million. No discount. Most safes on Carta don't have a discount, but if you do have one, it's typically 20%. So we've added. So now you see the friends and family line. They have a post money safe, this, but they don't have a share price. They don't have any ownership and they don't have any shares because you haven't put in any priced round terms yet. You haven't raised any priced equity. So let's go ahead and imagine that you did really well with that $200,000. In fact, you knocked it out of the ballpark. You're ready to raise a seed round after only a tiny bit of investment. So let's put in some terms for a seed round. Let's say in this seed, you're raising $3 million. Your pre-money valuation, this is all just kind of median numbers for SaaS startups on Carta, is 13 million. So 3 plus 13 gives you a 16 million post-money valuation, which is 4 times as much as the cap. And then you're going to need to put in some shares for the option pool that you're going to have for your founders. So typically this starts around 10%. At a seed round, maybe it's more like 11, but let's just go ahead and put 10. Hit enter. Whoa. Okay. Now we've got some cool, interesting information. So start with the overview. Your company is now worth $16 million. Awesome. The percentage of ownership that the safe and convertible note holders, those initial friends and family, they own 3.56% of your business. Those new investors, whoever those new friends are that gave you this price round, they own 19% of your business, just under 19%. And then David Bowman, who was one of the founders, owns 33% of the company. Excuse me. And Frank Poole, his co-founder, also owns 33.84% of the company. So you can see this is a wonderful tool to say, imagine I raised at X amount, and let's explore what that means. So again, if, for instance, you just said, maybe we start the pool at 5%. Okay, so that just bumps David's percentage up 3%. And the note holders own a little bit more as well. But we want to make sure those employees are incentivized, so let's do 10. But let's say we just found an investor who absolutely loves this business. He gives us a $16 million valuation. Cool. So that, again, bumps the ownership up from 33 to 35%. So you can see, you can just play around with the terms here, and you can see how it impacts various ownerships. And you can actually even just drag this valuation line across the chart and watch the numbers move. Pretty awesome. But of course, most companies, and this is kind of a debate right now in VC, there's going to be a lot of companies who try to take very little money and get as far as they can with that money before raising a priced round. I think that's a wonderful way to build a business. But most companies are probably still, if they're trying to be venture capital backed, which that's the first choice. If you don't need VC money, don't take it. But if you do think you're going to need some, you might need a little bit more than that. So let's go ahead and add another safe to the mix. In this case, we'll say this is your pre-seed round. And it's going to be a safe, a post-money safe. And in this case, you're going to raise $1 million. And the valuation cap, you made some real progress with that angel money. So maybe this is a $10 million valuation cap instead of a $4 million one. All right. Now, again, if we just zero these out, before it converts, no one has a share price, no one has ownership, and no one has converted shares. Let's throw in the numbers again. This time, maybe you raise, we'll just do the same kind of figures, $3 million more dollars at 13 pre-money and a 10% pool. That pre-seed round owns 7.12% of your company, and friends and family are stuck right at 3.5%. So those total safe investors are just under 11%. And that meaningfully changed David's ownership. You know, that went from 34, 35% down to 30. So again, you can watch this move and say, oh, the more that I fundraise on safes, whatever the eventual conversion will be, has deep impacts to my ownership as a founder. Not to say it's a bad thing. Maybe you really need that money. That's a totally fair way to think. But don't just fundraise on safes because it seems like everyone else is doing it. Raise what you need. And then if you need a little bit of buffer to get to the next round, I think that's a good idea as well. So this is just an example of the tool. You can continue adding safes, continue adding convertible notes, et cetera, et cetera. You can also take a look at a priced round. And this is basically just doing that same math that we were just doing, but we're doing it from the opposite terms. So you can add more safes or you can change the terms of the price round. You can also do a couple things that are important. So in the free version of this calculator, you can change the conversion method on your safes from pre-financing to post. What that means is most of the time when you're negotiating with your first price round investors, they're going to ask you to take on all the dilution from the safes. They're going to say, look, you're going to convert those safes and you're going to dilute yourself and your friends and family and not us, because they don't want the dilution. They want to own 20% outright. That is negotiable. I will say it's pretty hard to negotiate that these days. So you can try, but maybe they'll expect it to happen before you actually fundraise from them. And then the same thing with the option pool. Does this option pool impact everybody, or does the equity for this option pool, it only dilutes people who are currently on the cap table? It increases in the pre-money stage versus the post-money stage when it would dilute everyone on the cap, including those new investors. These are kind of complex terms, but they can have deep impacts on who owns what percentage at the end of a fundraise. The other thing that you'll want to negotiate when you're doing these rounds is pro rata rights for these investors. So what is pro rata? Effectively, think of pro rata as giving somebody a right, but not the obligation to continue to invest into your business if they'd like to keep a hold of that percentage stake. The National Venture Capital Association has some great documents on this, and that is the standard is to say that they are entitled to participate in the round that is equal to the percentage that they basically already own. So if you own 10% at the seed, you can try to keep your 10% at the A. Or you can zero dilution pro rata, which is you do the same thing, but you don't factor in the dilution from the other investors. One note, you don't give pro rata to everybody. It may seem like everyone's asking for it. Typically, the lead investor can have pro rata in a round, but it doesn't apply to everyone. So this isn't a term that you want to just throw around willy-nilly because it can make future fundraising a little bit harder. So you can apply that to your models. You can go ahead and change the terms, et cetera, et cetera. So just a tiny pitch here. Whether or not you do this on Carta Launch or not, I think it's useful to start here, of course. But you want to get familiar with how raising money will impact your ownership. And if you're raising safes, especially multiple rounds on safes, that can be less, it can be much less intuitive than you think. So of course, you can do this on Carta Launch. There's about 12,000 pre-seed startups on Carta Launch right now. You issue equity to your team, raise on safes, all of that completely for free until you raise $1 million. So if you scan that QR code, you can get to Carta Launch right now. And there were some questions in the comments that I am going to touch on now. Let's say, moving from one round to another, is it industry standard for a VC to insert a discount for the next fundraising round? Not discounts really apply to safes and convertible notes, less to fundraising rounds, like price rounds. So not super common, but there's all sorts of creative structures that VCs can come up with. Aziz, yes. To this question, absolutely. You can skip all of them if you want. Never fundraise. Bootstrap yourself to a MailChimp outcome, which is $10 billion. You can do whatever you want. There are no right ways to move through this venture path. The only reason that we project this in seed, A, B, safes, blah, is because we need some structure to talk about where companies are in their journey. But you should definitely, if you can, skip rounds. Hold on to more ownership. Get to there. There's a growing trend, which is younger startups trying to get to at least line of sight to profitability, if not outright profitability, earlier on in their journey. But if you're a profitable company, you control your destiny because you don't need extra fundraising. I will say, it is very difficult to be a, say, profitable seed stage company and get to $1 billion in a very quick amount of time. So the typical venture journey, they want you to get to 100 million ARR and $1 billion valuation in 5 to 7 years. That's really hard to do if you start from profitability. And the reason being is you probably could be spending more money that's making you profitable to fuel growth. So that's the bargain when you take VCs. They're going to want you to grow as fast as possible. And perhaps that isn't the company that you want to build. And that's totally fine. You do not need to commit yourself to venture capital growth rates unless you take their money and then they're going to ask for it. So I love the idea of this new wave of VC lean or light VC, where you take between, say, 1 or 2 rounds of financing and then stop funding. I think a lot of companies are going to try it, and I think it's going to result in some wonderful outcomes for many, many founders. But it is harder to get to $1 billion in valuation without outside capital. There's just no denying it. We point to examples like MailChimp and others. We don't have a ton of other examples. I'm sure that people will put them into the thread and say I'm missing some, but in general, it's a lot easier to get to really, really high valuation numbers if you're taking on outside capital. You pour that capital into growth. So it's a really interesting time. I hope that there's a lot of new ways to build businesses that skip rounds, as the question implied. So Craig's question is another really interesting one. Mechanisms for addition of equity to founders. Are there ways that founders can actually get more equity later on? Yes, there are. They come in two forms. One is refreshes, so equity refreshes for the founder. That's typically done when the VC is worried that the founder is going to leave. So if the VC looks at your business and they say, this is an awesome business, but I do think that you, Craig, are undercapitalized in this business. I'm worried that you might not go the distance. Maybe they actually refresh your equity during a fundraising round. The other sort of value, I'm not sure if you would call it an increase of equity to founders, but of course, we haven't touched on secondary markets or liquidity at all in this deck yet. So let's touch on it now. In the early part of venture capital, so this is, call it the dot-com boom even, it was pretty frowned upon for founders to sell any of their ownership at the early stages of the company. There were a lot of reasons for this, but primarily it was just seen as you're not fully committed to the business. During the most recent boom in the pandemic, it actually became a lot more common for founders to take a little bit of money off the table during a primary round. So how that would work is you are raising a Series B, and as a part of that Series B, you actually sell a little bit of your equity to the new investors as the founder. So maybe you make $1 million. I'm just throwing numbers out here. And then that million obviously becomes cash for your family. You can take care of life events, but you're still really highly incentivized in the business. That became a lot more common in the pandemic. And then it kind of, again, became a little bit, I wouldn't call it taboo anymore, but less common in the last couple years. Personally, I think that founders should not starve themselves in order to build these businesses. I don't love the idea of founders, not taking any salary and not having any cash compensation. So it's just a discussion between you and your investors as to whether or not founder secondaries are something that you want to consider. But that is a part of the venture sort of toolbox that became a little bit more real over the last 5 years. That's a good question. So I know we ripped through a ton of questions here. I want to get back to one that I thought was particularly insightful about why are safes a thing now? And what are the pros and cons versus a price seed from founders and investors? Okay, let's go pros from the founder side for safes. One, they're faster. You don't negotiate all these terms with a lot of lawyers. You can move quickly and sign up your investors. Two, again, when we talk about legal, they cost less. You're probably not going to involve a lawyer, although you should if there's a side letter, in a safe round. Whereas if you're raising a price round, both sides are going to have lawyers. And in the end, the founder is probably going to pay for both sides' lawyers. So that can be expensive. And the third reason is that they're rolling. So you don't need to have a round that's filled out at the exact same time. You can sign a check here and sign a check there with a safe and keep moving, keep building your business. So the pros are speed, cost, and sort of ease of use. Let's call it convenience on a safe. That's the pros from the founder side. Talk about the cons from a founder side. One, as we just modeled out, dilution can get tricky to track. So if you're doing multiple rounds of safes, you might not actually know how much of your business you own. That's a problem. Two, safes have a valuation cap and a discount and are anti-dilutive in their nature. So what does that mean? If you fundraise on a price round, call it a seed round. When you fundraise on your Series A, whatever happens to your ownership, it's also going to be happening to that investor that came on at the seed round. You're both going to have your slices of pie the percentage is slightly decreased. the new investor is going to impact all of you. If you are going to fundraise on safes and multiple rounds of safes, that first price round, it only impacts you, the founder. The safes are sort of removed from that equation. They're anti-dilutive. So that is a benefit. That's a pro for the investors, but it's a con for the founders. And it can be why there's some debates about, you do hear founders who come up for air after their seed round and go, I just don't own as much of this business as I thought I would. That's a problem. So that's a con. The other con is that they make things a lot more confusing, especially in between price rounds. I was talking to a VC who I really respect, Kate Beardsley of Hannah Gray, the other day for a podcast episode. Plug for the podcast. It's coming out soon. And she had a wonderful perspective on why an equity round early on can be useful, especially if you end up trying to get acquired earlier on in your life cycle than you expect, because that's the backstop. That's the foundation on which a real acquisition offer can be made. Whereas if everyone's just safes and it's kind of vague, it's much harder to agree on valuation and price. So there are some negatives to safes. In general, my view is that safes are a wonderful way to get started, but founders should probably move to priced equity a little sooner than they're doing now. So that's a personal view. There's 1,000 ways to build a company, but cleaning up a cap table with 4 or 5 different safe rounds, that gets tricky really fast. But this is a great question. What are common terms with growth equity rather than venture capital? So I think that this is a question that comes into play when you're, call it Series C-ish, series, middle to late stages. You might start interacting with growth equity or private equity investors instead of just venture capitalists. I'm actually a little bit divorced from that arena. I don't want to give you wrong terms, but I'd assume they would ask for many of the terms that VCs ask for: most favored nation, pro rata, information rights on your cap table, equity terms that give them the right into veto board seats. There's a lot of different ways to improve the quality of an investment for investors. Vishva, what is the acceptance and practical performance of the fair shares commons? I'm not actually sure what that means. If we're talking about common shares, those are owned by founders and founders and employees, whereas investors own what's called preferred shares. Why is it common versus preferred? It's preferred because there is a preference given to those shares at the event of an exit, meaning they get paid out first. The liquidation preference, which is the common multiplier on that, assumes that if an investor gives you money in a VC round, most of the time, almost all of the time, that investor is going to get their money back before anybody else gets any cash. So if you raise $10 million and you exit for $12 million, that investor gets the 10 million back before anybody else shares in their pie. That's called a 1x liquidation preference. There are some people who are signing 2 or 3 or even 4x liquidation preferences right now, meaning investors get 2 or 3 or 4 times their money back in the event of an exit before anyone gets any cash. Now that's rare, but it is happening. And it suggests that the cards are sort of more in the investor's hands at the moment when it comes to venture fundraising. So it's a tough environment out there. There's a lot of different preferences that go into why investors get better treatment than founders and employees when it comes to equity grants. Considerations for founders with multiple investors in a syndicate. So I'm assuming this question means multiple or just one syndicate with multiple investors, which is totally fine. Syndicates basically kind of roll up the check into a single line on your cap table, and then either through an SPV or a cap table vehicle, and then they just appear as one line on the cap. That's totally fine. There's a lot of different opinions about the value of syndicate investors. Sometimes some people say they're less committed to the company because they're just kind of further away. They don't actually have a named line on the cap table. Some of them say that it's a fantastic way. I think it's basically it's, if you think that's good capital, then you should take it. Vishvai, see your questions. I actually am not an expert on the fair share model, so I won't be able to tell you too much about that. The other questions that we're getting are there any stats on how much founders sold? I'm assuming that was in the secondary conversation. There aren't a lot of stats. It's generally small percentages of the company that they would be selling, especially early on. When you get to really, really late stage companies, Series F, G, pre-IPO, maybe it's a little bit higher, but we can go back to the chart here and say, Atlassian founders didn't sell a thing. Basically, they IPO'd with 75% of the company, whereas there's really not much that they did. DocuSign founders maybe they took some off the table along the way. Really, it comes down to supply and demand, and by that I mean, what is the demand for your shares and what is the supply of them? And if the demand is very high, if you are a very hot company that is in high demand, then you might have the ability to increase supply by selling some of your own stake, if that's something you want to do. So I personally think that founders should be able to transact in equities and secondaries if they so choose. Hopefully also then allowing their employees to do so as well, so that we can have some liquidity for employees down the line. It's a tough market right now with the no IPOs and much fewer companies getting acquired. So hopefully that IPO market comes back really soon. Oof, we went through a lot of stuff today, team. I really appreciate you sticking with me. I know we're coming up at the top of the hour. If you have a couple more questions in the chat, I'd be happy to take them, or the comments here on LinkedIn. Mikhail, I don't have any valuations data on compound startups. I'm assuming that means the rippling approach. I don't think that's a segment in our data set, but it's a good question. It's maybe something I can answer later on. At the end here, dilution can sound scary, and it can certainly be a sticking point when it comes to negotiating with investors, for instance, and other people that want to get on your cap. But the standard saying, I think, really applies here. 5% of $1 billion is a lot more fun than 100% of nothing. So when you're talking about dilution, yes, making sure that you're keeping track of your ownership, your co-founder's ownership, and the ownership of your employees is crucial, not least because it's going to allow you to guide yourself to how much money you can raise later on. But in the end, if you want to get to a venture scale business, I think that slide that we showed at the beginning with the average founding team owning about 18 to 22% when they IPO suggests that at some point you're going to sell the majority of your company to investors. That's the most common pathway through the venture capital landscape. Not all the time, but it happens a lot. And that can still be an unbelievable outcome for you and your employees, and a life-changing one for everyone who's invested in your business. So hopefully those IPOs kind of come back really soon, and we can see a lot more examples of that wonderful exit behavior in the future. All right, I'm going to end right on time. Thanks again for joining us. We do these about once a month or so, either through the audio format here on LinkedIn or a deep dive into slides and fun modeling like we did today. Hope that you found this useful. And if you did, give me a shout on LinkedIn or go ahead and follow us and follow the podcast. I wonder if we can throw that podcast link up here. So if you're not familiar with it, we have a podcast now. It's very similar to our newsletter. It's called the Data Minute. I sit down with VCs, lawyers, founders, anyone and everyone who cares about startups, and I talk to them about the most fascinating data that we're seeing. So please give it a listen. We hope that you enjoy it, and we'll check back with you next time. Thanks so much. Cheers.